valuable. So welcome to our WET webinar 7.0. My name is Mercy Edukugo Amina, and it's truly a pleasure to welcome everyone to have you join us for today's session. Is at a very pivotal period in Nigeria's fiscal and regulatory journey, one in which we've seen that transparency, accountability, and compliance are no longer ideals, but there are legal and commercial realities. Over the past year, Nigeria's tax landscape has undergone significant reform, redefining how income is identified, how value is assessed, and how taxpayers, individuals, and businesses are expected to engage with the tax system. Transparency is now the central theme, from clearer rules and expanding tax net to stronger enforcement and data-driven oversight. For taxpayers, you and I, this presents both new responsibilities and new opportunities to plan better, operate more efficiently, and engage the system with greater certainty. Today's discussion, our conversation, is not just about understanding the law as it's written, but about interpreting what it means in practical terms. How these new acts, how they affect decision making, risk management, how you can structure your businesses and your finances, and long-term planning, particularly how they affect us as individuals in our professional lives, our businesses, and for those of us that are globally mobile, that operate within the digital space. How does this also impact us? We are privileged today, this morning, to be joined by a distinguished panel of experts who will help us unlock these developments. They will help us to separate, like they say, fake news, the myth from reality, and they will offer practical insights on how best, as individuals, as families, as businesses, we can navigate Nigeria's new tax regime with clarity and confidence. My role today is simply going to be that of the moderator and the host to guide the conversations as they unfold. We'll try to keep it focused and ensure that as much as possible that we bring out the practical realities, the real gist. We are not beating up around the bush. We are bringing everything out so that at the end of the day, we would have the technical input as well as the commercial input and find out what and which is relevant for us. Once again, thank you so much for being here. So let's begin. This conversation is broken down into several parts. We will be looking at the individual taxation, the income, the deductions, and global income rules. We'll be looking at corporate and family businesses and the taxations that apply to these entities under the rules, under the new Tax Act. We'll be looking at asset management, the chargeable gains, and the tax that applies when you are managing your assets. For those that are interested or those that are already with global footprints, either as individuals, as businesses, as families, we would look at the cross-border transactions and non-resident taxation issues. Where we sit as fiduciaries and as trust and estate practitioners, we would also look at trust and estates. How do we manage fiduciary obligations and the tax exposures that come with it? The digital economy and visual assets. What is in it? Taxing techpreneurs and those that earn their income from online revenues, streaming, just name it, all things that happen within the digital space. how will the Tax Act impact us and impact our obligations therein. We would also touch on philanthropy and charitable donations, how we can structure and utilize same for tax purposes. What are the incentives that are available? Before we get started, we would just like to just put some house rules in place. Please let us use our full names. Let's display our full names for easy identification. This helps the facilitators and everyone to address us properly. When we are not speaking, please let us mute so that we would be able to minimize the noise, background noise, and disruptions. We encourage everyone to be present, stay focused, and as much as possible, just minimize multitasking. And let's use the chat box responsibly. We would be monitoring it for questions, for any clarification. So please, if you have questions or any other thing, please bring it to our attention there. The team is ready. Please, let's avoid spamming it for off-topic conversations so that the questions can be read out at the end of the session, and we will take all questions. At the end of the sessions, we would also enable anyone that wants to ask questions to raise their hands and also to use the reactions to speak. And as we contribute, let us try as much as possible to be civil to others that are with us in the room. Without much ado, I would like to introduce our first panelist, Dr. Paulinus Iyika. Dr. Paulinus Iyika, PhD, ADT UK, is an assistant director with the Nigerian Revenue Service. Now, for those of us that know, we know the NRS started being the NRS just about 1st of January this year. It was formerly FRS. So it was formerly the Federal Inland Revenue Service. It has over 14 years of specialized experience in tax audit investigation, international taxation, transfer pricing, and tax treaty administration. As a pioneer staff member of the International Tax Department, Dr. Iyika has played a critical role in establishing Nigeria's international tax and transfer pricing frameworks, including developing operational processes, leading complex multinational TP audits, and heading compliance and enforcement for transfer pricing returns and country-by-country reporting. Dr. Iyika has also contributed to global tax policy reforms and strengthened Nigeria's engagement in international tax cooperation initiatives, including the OECD's led BEPS project and the ongoing two-pillar solution addressing the taxation of the digital economy. He actively supports legislative review and capacity building initiatives within the Nigeria Revenue Service and is a recognized thought leader and researcher. He holds his PhD in development finance from the Covenant University and an advanced diploma in international taxation from the Chartered Institute of Taxation, UK, with extensive publications and speaking engagement on tax digitization, base erosion, profit sharing, and domestic resource mobilization in developing economies. So you agree with me that he is indeed the expert that we need in the room today, especially for cross-border, for digital and virtual assets, and all other matters that concerns corporates within the international as well as the local Nigerian space. Our second panelist discussant is Mr. Aino Joseph Tunji. Mr. Aino Joseph Tunji is an accountant. Is a seasoned chartered accountant and management consultant with over 2 decades of professional experience spanning audit, taxation, business recovery, insolvency, and strategic advisory services. He is a 1999 accounting graduate of Kwara State Polytechnic, Ilorin. He completed his NYSC in Calabar, and he is also pioneered an educational initiative that has gone into a full-fledged secondary school. He started this during his NYSC days. AJT, for those that are familiar with him, is trained with leading accounting and valuation firm and is a fellow of the Institute of Chartered Accountants of Nigeria, with memberships across several professional bodies, while also currently pursuing his MBA. He is the managing partner of Tunji Aino and Co. Chartered Accountant and lead consultant at IC Pro Professional Services Limited. He's a regular facilitator and presenter for professional bodies and corporate organizations, including the Manufacturers Association of Nigeria. So it's a great pleasure to have both Dr. Iyika and Aino Joseph Tunji with us today. So thank you so much, gentlemen, for being here with us today. And like we have said, we have themed this session as the era of transparency. It doesn't seem like there is any hiding place right now if you if you are a Nigerian, right? So as long as you have an income coming to you, it seems that all everything is set up to make sure that you contribute to the national development with respect to payment of taxes. So gentlemen, thank you so much for being here. I'm just going to ask us now that respectively, so we will start with Dr. Iyika. If you were to tell anyone that is now in this meeting room with us, this webinar with us, we have businesses here, we have family businesses here, we have settlers, we have trustees here, we have people that work within the creative space here, those that work have that are professionals and also work within the digital space. If you were to summarize the key changes that impact each and every one, each and every person, every class of Nigerian, what would you say are those key changes? And how do they differ from the previous tax regime that we have in Nigeria? So, Dr. Iyika, yeah.
All right. So, good morning, everyone, and thank you for having me to be part of this conversation. Okay, so for me to respond to that question, I think it's a bit of a very broad one, but I'll try to summarize it. So I think basically the idea behind the reform, I would say, is to, as much as possible, make it easier for businesses to thrive, right? In the sense that what we had before, we had a situation where, someone would say that for every challenge that was faced in the country, so to say, there was always a tax law promulgated to deal with that. For example, there was need to increase funding in education, so there was education tax. There was a challenge with maybe information technology development, and there was NIDA levy, and then NASENI came up for infrastructure. So almost every issue has a tax to address it. So again, government felt there's a need to, because that makes businesses struggle to even know what to comply with. Because when you have a lot of such taxes or obligations scattered especially in different books, so it makes it difficult to keep track of that. So the government felt it's important to harmonize all of these various taxes and consolidate them to make it easier for taxpayers to actually comply. So that's what gave rise to what we call the development levy. So all of those other taxes paid by corporates are now consolidated into one called development levy. That is aside the corporate income tax and other taxes, including the VAT and the rest. But again, this is also to aligning with global best practice, because if you look at most countries too, we don't have that kind of fragmented, taxes all over the place. So at least if you're talking about levy is 4%. Then every other thing else is taxes, right? So it's always important to make that distinction between a levy and then a tax, right? So that is just that. So again, apart from that, simplification was also one of the key, pillars that informed the reform. So the government also felt that the need to simplify the system, apart from harmonizing them, it's also important to simplify them because some of those laws were written, several decades ago. Take the Stamp Duties Act, for example. I think it was written as far back as 1939 or so. So you can imagine the kind of language used in the law. And even throughout my career, it was one of the taxes or tax codes that we struggle to understand. All right, because of the kind of language used there. You hear things like embossment, things like adjudication, and all kinds of language there. So that has largely been simplified to make it easier again for compliance. Okay, so and the law also focused, like I said, making it easier for businesses to operate. The law also, apart from simplification, the law also tried to introduce a number of thresholds. In some cases, increase the thresholds, right, of exemption for businesses. For example, for you in the past, for you to qualify for exemption under the company income tax in the past, you have to have a turnover of threshold of about 25 million annually. So you mean that what that means is that whether you're a content creator operating under a limited liability company, then you have to get up to 25 million. If you're operating less than 5 million, you are exempted, from company income tax and including VAT at the time. So, but now that has even been increased to, of course, to 100 million. Now, saying that is actually increasing the number of people that are off the nets, right? For example, so just to encourage small businesses to also grow. So, I think, I would just summarize by saying that the whole objective is taxing right and not taxing more, right? I mean, some people, I've heard some testimonies so far. Some people saying that when they saw their salary this month of January, those that have gotten salary for January, they noticed that there was an increase in their take home, right? So that tells you that, of course, that the government is actually living or walking the talk. So contrary to what was out there, that it was all about trying to kill or strangle people or strangle businesses. So that's just a way. I'll just leave it at this point so that we can proceed. Thank you.
Thank you so much. Thank you so much. Okay, so Mr. Yes, your comments on what are the key changes?
All right. Good morning once again. It's a pleasure joining us on this platform, and I want to appreciate my doctor that I've just spoken now. One of the areas that has been touched is the area of capital gain tax. Initially, capital gain tax was not harmonized in line with the corporate income tax. Initially we're applying 10% tax 25, but now capital gain tax has been harmonized to align with the rate on corporate income tax, which is 30%. And initially we had initial allowance, annual allowance, but now the initial allowance and annual allowance has been cancelled. That is the area of capital gain tax. Then for capital gain tax also, there is a relief for a capital gain on personal residence, that's personal building that has been sold by the owner, unlike before. Doctor has spoken on the relief. Then we have initially in the Personal Income Tax Act, we had a consolidated relief. But now, because of the ambiguity and the bureaucracy, the issue of consolidated relief has been cancelled. So we now have two basic relief. Any salary earner or anyone that earns income that is below the national minimum wage of 800,000 is exempted from paying personal income tax. And there is also a rent relief of 20% of your annual rent, whichever one is lesser, either the 20% of your annual rent allowance of 500,000. So the maximum amount for the rent relief per annum has been kept at 500,000 naira for a taxpayer. Thank you.
Okay, so when you started speaking and you started talking about capital gains tax, I know you went into the nitty-gritty of the key changes, and capital gains tax is also part of it. As in, we know what that cost in the capital market when the acts were first shared, right? So a lot of people would not even know what capital gains tax, or may require a little bit more clarification. So, Mr. Tunji, back to you. So please clarify what capital gains tax and how does it impact. As an individual, are you concerned about capital gains tax? As a corporate, as a business, are you concerned about it? Yeah, what is it?
All right. Capital gain tax are the gain you make on disposable assets or the digital platform now. Whatever money you make on the digital platform will be subjected to capital gain tax. Capital gain tax will be on property such as your building, your cars, vehicles, even your jewelries. So initially, before now, when you sell your property and you make a profit, on that profit, you must pay capital gain tax. How does this one apply? When you have, for example, if you buy a property at the cost of acquisition, 100 million naira, and over the years that asset has appreciated, and you want to put it into the market for sale. The law says that whatever you realize from that fixed asset or that asset, for example, let's say you eventually sold it for 150 million. The law says whatever that you have spent on it to bring it to a saleable condition, maybe you renovated it, you engage a valuer, you engage an accountant or a tax consultant, you will have the cost of renovation and the cost of professional fee that you pay on it. Let's assume that the whole thing come down to 20 million. 20 million plus 100 million. That is the total cost. Then you will subtract it from the 150 million naira, the same value, and you'll be having 30 million naira. So going forward from this new tax regime, it is 30% on that 30 million naira that we are going to pay. But for an individual who sold his personal building, residential building, the law exempts such gain or whatever, or says from the capital gain tax. But for a corporate organization, or you as an individual, you build a property and you put it into business for the purpose of capital gain, when you sell such an asset, you have to pay capital gain tax. The rate has increased compared to previous one. So automatically, it takes more money from you as a corporate entity. But for an individual who sells his personal property, is exempted. So that's the little changes that has to do with capital gain tax. Thank you.
Okay, yeah, thank you. So yeah, so for capital gains, individuals, especially if it is your
Personal,
property, your personal,
yeah,
yes, your personal property,
residential, yeah,
your residential property. Okay, that would be assumed to be very dire circumstances, right? Okay,
yeah.
but yeah, so you don't have any concerns with capital gains. But if that property that you have is put to business, maybe you put it to lease, to rent, and that has been the history for that property, because you really can't stay in how many residential houses can people, because this is about structuring as well. Is it possible for people to denote all the properties that they want to sell as residential for the purposes of just structuring and managing their tax exposure?
All right. This thing is all about documentation. All about documentation. So but you know, one thing I'm looking at it this way: for an high net worth individual, you begin to change your document, change your document. I want to believe maybe there's going to be a section of department in NRS that will actually look into this area, because if the windows is open to everyone, then virtually everyone will go and change or ratify their documents in to their personal name. But at the same time, it is not also good or totally right for you to change all your properties, the documentation or document at title in your personal name for posterity's sake and for asset preservation and for succession planning. All right.
Okay, thank you so much. Okay, so we're just going to the next question, right? um and this one is very important. um there's a lot of conversation about Nigerians, I mean, born of Nigeria, naturalized in Nigeria, you have anything to do with Nigeria, I mean, all coming within the tax net, right? So what would we say is the definition of worldwide income? So I mean, under the new act, and how who are those that, when you say they are global, a Nigerian's global income or their worldwide income, what is that? And how do you manage your exposure for the purposes of not wanting to fall into that space where your worldwide income um becomes something that the taxman comes chasing you after?
All right. Thank you so much. So when we are talking about worldwide income, we are talking about our government looking beyond Nigeria as a citizen to look at the sources of your income beyond Nigeria. So, and there are rules to that. So when we're talking about the rules, the issue of the law of residency comes to play. The law says that for a Nigerian to be taxed, okay, for example, if you live in abroad, you are earning your income in abroad, you'll be taxed over there. And if you come to Nigeria and you now stay beyond 83 days, that means vital part of your days are spent in Nigeria. So the law says that they should take that 83 days and above as a year for you, and you'll be taxed also in Nigeria. So if you're based in abroad and you live below 183, maybe you come on business purpose and for visit, and you spend lesser than 183 days, the law says that you will not be taxed as a Nigerian. But once you stay beyond those days, or you have economic presence as a citizen, you have a source of income in Nigeria, either you work in Nigeria more than 183 days and you are being paid, or you have business running in Nigeria. If you have business in Nigeria and you live in abroad, there is no way that you will not be taxed because you earn something from that business in Nigeria. So what the law is saying is to expand the capital income tax base for an individual who has the opportunity to live as a citizen, maybe as a dual citizen, or maybe more than a two-country. Once you live beyond 183 days or up to 183 days in Nigeria, you'll be taxed. The law of residency will be applicable to you. So it's to tax the local income and the offshore income. That is what is known as worldwide personal income tax. Then for you to be able to manage is for you to be able to look critically at your calendar and make sure that you don't live beyond 183 days in Nigeria. Thank you.
Okay, so the structuring part is just to make sure that, and I know, and so this is actually making us to be a little bit globally aligned, right? There is quite a number of people that I know in some countries, because they know that they have residency, they stay there, and they kind of just manage their calendar in such a way that it doesn't trigger. So you have them, the next thing you see, they have left, they've come back, they spend like another couple of weeks, then they are back again. All this, so this has just made Nigerians also come into that same system where you have to check, okay, my location, my residency, and what I'm doing, would I be tax liable? So it's not just pack your bag and go, just like we do as Nigerians, and not be bothered about, okay, what benefits do the Nigerian government take from us? So this is making us a lot more aware and globally aligned with other practices that other citizens or even ourselves do in other jurisdictions as well, just because we want to make sure that when it comes to the tax net, we are able to manage and work our way around it. So thank you so much, Mr. For that. That goes back into being able to structure, look at your calendar to make sure that if you know that you are in the abroad, you know that you are in the Canada, you know that you are in the UK, you know that you are in the Belgium, you are in the Spain, and you are in Brazil, you want to come into Nigeria, you better look at your calendar and make sure that you adjust it appropriately, so that the incomes that you would so that the taxman in his computation of income that you've derived out of Nigeria, or revenues that are derived out of Nigeria, actually are a true reflection of your position, and it doesn't become a case of I said, you said. Okay, Dr. Yika, do you have any comment you want to make with respect to the worldwide income or the global Nigerian having to ensure that, and the government's role in having to ensure that you are globally for the footprints you have within the global space, and you have revenues originating or coming from that you make that you also that you be tax responsible in the country?
All right. So thank you, Mr. For at least doing justice to that question. But for me, I would just add that first of all, what the law tried to do in this reform is to tighten. I mean, the whole concept of residency for individuals didn't change. All right, there was no significant, there's no change at all around the definition of residency. Residency still remains, of course, why it's 3 days. That is the basic, I'll call a basic indicator, right? Because there are other things that actually are used to determine, especially in international taxation, when you have to do with somebody having dual residency, then we'll begin to look at other factors that include habitual abode. Where do you habitually stay? Right, that could be also used to determine where your residency is, even if you are trying to beat the 1 to 3 days concepts. Right. Again, we're looking at where do you have your principal, abode. Right. Where do you have a principal? Where do you have what they will call in immigration, what they call ties? Right. Where do you have strong tie? So that could also be used to determine where you actually should pay your tax. So it's not necessarily the issue of number of days. It's not just restricted to number of days. But like I said, there's not much that changed around the definition of residency for individuals. Okay, but again, there's also an effort to make sure that there's a link between the charging provision. Of course, we talked about the incomes to be subjected to tax, and to the other aspect of the reform. For example, there's now increased focus on substance rather than just what you declared or what you presented. So there's going to be more focus on substance. For example, government will now be looking at even third-party confirmations. For example, exchange of information is also there. So there's a link between the exchange of information between the country where you are living or where you are currently based and where you're from. So your nationality. So there's a link. There's a strong focus now on exchange of information between these jurisdictions. And Nigeria actually certainly belongs to a number of these, both bilaterally and even multilaterally. We belong to a number of corporations that have been established for the purpose of exchange of information. So I can actually write to a country, even if we don't have a bilateral agreement or treaty, or call it double tax treaty, even if we don't have a double tax treaty with them, I can actually kind of leverage on other treaties that are multilateral in nature. Tax information exchange agreement is also there, where we can explore and get information about that particular individual or corporate entity. So now there's a lot more focus on transparency, because this is talking about transparency. There's the days of saying, okay, I mean, government is not able to see what I'm doing out there, so I'm just going to declare what I want to declare, has actually passed. So and if you look at there's a very concerted effort to align the tax administration generally, to what the OECD has referred to as tax administration 3.0. So we're now moving to 3.0, whereby government is not just going to sit back and watch you declare. Remember, before now, what we operated was a government assessment. What I mean by government? Government is the one that determines what you pay as tax. And this was like way back before. Globally, there was a shift, and then there was a move towards self-assessment, meaning that, okay, government will trust you to self-assess yourself and then pay your tax and file your returns. So, but because of the increase in tax evasion and global tax avoidance, so government is shifting away from that to say, okay, now we need to even look beyond just, we need to move beyond just waiting for you to declare. We want to be involved in what you are doing. And that's what is leading to, for example, the case of the e-invoicing we're talking about today. Government wants to be involved in your business directly by plugging in technology, an API into your invoicing system, right? Such that they can see what you are doing as at the time you are saying on real-time online basis. So that's transparency in this case now. So we're no longer, it's no longer the time you say you're going to hide your income, and whether or not I declare it or I repatriate them into Nigeria, I will be out of the hook. So now government is saying that even if you don't declare them, right, and it's all about information, and they say they gather information that you have this income you're earning, but you're not bringing them forth. It's going to be also this tax in you as though you have declared them, right? So that is also, of course, there's a lot of development around this area. There's a CFC rule government also implemented for companies. Companies that, for example, that have, let's say, headquarters in Nigeria and they have subsidiaries in other countries, especially the tax havens. Jurisdictions we refer to as tax haven. So what most multinationals do is to set up subsidiaries in those jurisdictions. And remember, those subsidiaries in those jurisdictions, they're supposed to declare dividend and then repatriate the dividend to Nigeria this is where the shareholder sits. Then again, but because the shareholders the high net worth individual who are the shareholders want to manage their tax exposure, they would rather leave the money there, in the tax haven, right? So it's not taxed in the tax haven, it's not taxed in Nigeria. That's what we call double non-taxation. So we now move away from double taxation to double non-taxation. So now that is what the CFC rule is now addressing, to say, look, regardless of whether you brought the money back to Nigeria or not, it will be taxed in the hand of the Nigerian multinational at head office, as though that money has been brought back. Right, so especially where there's no evidence that if that dividend is distributed, there's not going to cause any harm to the subsidiary. So once that is proved, of course, it will be taxed in the hand of the head office, especially with respect to passive income. This is specifically to passive income, right? Passive income, we're talking about interest you earn on loan, we're talking about rents from immovable assets you have, we're talking about royalties you earn from intellectual properties. For example, the content creators, the artists, all those that manage different labels and all of that. And any royalties for all of that. So whether or not those royalties were actually declared by you in Nigeria, as long as there's information that you're actually earning certain royalties from certain people using your intellectual property, that's the tax as though it has been you've declared it. So that is just to bring out the aspect that government has brought into tighten all of these loose ends. Thank you.
Yeah, thank you so much, Dr. Ika. You know what? So I'm just thinking that, so the thing that came to my head is there's no hiding place, right? I know we think this in our understanding, in our understanding of this situation, we actually knew it's the era of transparency, that there's no hiding place. But with each passing day, you get to see that really there is no hiding place. So the other thing that came to my mind is, are we going to have situations now where Nigerians will now be renouncing their citizenship for just because of this whole tax situation? People feeling that, okay, you know what, this might be too much for me, especially if I'm an high net worth individual and I have some very valuable assets that are offshore, and I don't want the Nigerian government tax net to come in and all that. So these are just things, because you are feeling there's already a sense of what is going on here, how much of this is going to unravel, and each day it is unraveling. And the reality, just like we said, is that there is really no hiding place. This is about you understanding what your compliance obligations are, and understanding what the law says, and being and ensuring that you are
So
you
maybe
are on the good side. Yeah.
without interrupting you, sorry. I think I should just add that you know, renouncing your or denouncing your citizenship will not even help, because what is happening now is there's a global coalition around movement of what they would refer to as illicit financial flows, right? Illicit financial flows, aggressive tax avoidance has been identified as a key aspect of commercial illicit financial flows. So people use vehicles, people use sophisticated trusts, right, and corporate structures, to be able to hide their income, and then they hide this income behind these various vehicles. And then again, there's global transparency conversation going on. The OECD is driving through its global forum for transparency and exchange of information, which is an arm of the OECD. It's also driving towards making sure that countries have what they call beneficial ownership registers. So in this case, this is also what I'm aware that is being developed in Nigeria by the Corporate Affairs Commission, so that every director, every person behind every corporate entity, is no longer the time you set up a company and then faceless shareholders, and then the era is past. Now there's a requirement to disclose who the actual owners are beyond the corporate entities, because there's always a natural person behind the corporate entities. Whether you call it, whether you use a surrogate director, whatever it is you use, this is what happens. So there's a global discussions, and which is targeted or aimed at addressing all of these issues. So even if you change your your nationality and change it to another. I don't know what you want to change it to, but at the end of the day, it will still catch up with you in that regard. This is not to scare you, but like you said, it is just about trying to look into the law or get experts and professionals that will guide you through looking into the law and see it as much as possible. There are exemptions. There are, there are reliefs in the law that you can actually take advantage of as much as possible to reduce your exposure. Rather than if you change your citizenship, like or whatever, at the end of the day, there's also a global minimum tax that has been introduced. That even those tax havens, so-called, must implement the global minimum tax of 15%. So that place you're shifting the profit, you're hiding the profit. They're also under serious pressure. Currently, Bermuda has introduced a corporate income tax. Dubai has introduced a corporate income tax, and this was not existing in the past, right? So all of these people are introducing corporate taxes because of a global movement towards more transparency and more declaration more revenue by governments, given the fact that a lot of governments are struggling. COVID-19, for example, exposed how fiscally disadvantaged a number of countries are, especially developing countries. So there's a lot of move towards more transparency, towards more revenue in order to for government to fund basic services. So
yeah,
that's
thank you.
Yeah.
All right. Let me quickly chip in.
Yes,
Thank you so much.
Yeah.
Thank you so much, Doctor. Thank you so much. Now, can you hear me?
Yes. Go ahead, Mr. Tunji.
Okay. My own contribution is okay. This one shouldn't stop anybody from cutting down their citizenship, so long that it is what you make that you pay tax on. And Doctor made mention that tax experts or consultants should be consulted. So if you have a citizen, as a Nigerian citizen, you have maybe dual citizen or more than two, whatever business you do and the income you generate is what will be taxed. Okay, let's take this as an example. Because you didn't want government to tax you in Dubai, you didn't want them to tax you in United States of America, you now decide to come back home. And before now, you are doing well in different countries, and the tax that you are paying doesn't really bring you down. Only that probably there has been some shady or hiding. But what government is looking at is 100% transparency and pay whatever you need to pay, either to Nigeria or to wherever country you are operating. So to me, the new era of taxation shouldn't be an issue for anyone to think of maybe disowning their citizen from of other country. Thank you.
Yeah. Thank you so much. Yeah, so that's a bit comforting. I mean, for me, over time, the way I conceptualize, the way I look at tax, especially when people have a lot of concerns around it, we never really used to have a lot of it. It was always when you're talking with other professionals, some other professionals globally, you find out that a lot of the conversations is always on tax. I'll go for these conferences and I'm like, why is everybody just settling in on tax? Okay, how do you structure your estate, your trust? I mean, in Europe, in North America, that was always one of the key things. And because we didn't have so much of that rigor. Yeah, it was just your normal payee and some other things, and just you could actually manage it. But right now it's looking like I said earlier, Nigeria is becoming more globally aligned. So we are going to now start having conferences where we would also be making presentations on, okay, so this is how you structure, this is how the tax impacts you and all that, rather than just saying, okay, you know what, it's not really, that's not it. We really want to make sure that these are structures that are sustainable and all that. Because when you go to the US, to the European markets, as well as the North American market, you find out that a lot of the structuring, a lot of the things that are put in place is because there is a tax element there, and people are just trying to work around what is legal and what they can do. So right now we are inside that. We are, as if we have come full circle within that as well. So the need for advisors, the need for tax practitioners, I mean, you cannot overemphasize it. So it's very important that as businesses, as individuals, that we engage the right professionals and advisors with respect to what we can do and how we can go about it. This era of transparency that we have, because even if we don't do it ourselves, whatever locations that we are in, there is already the exchange of information that's been ongoing, and this is just consolidating it. Then you also have the automation that has come into the whole force. So you find out that it is going to, there really in essence is no hiding place. So Mr. Aino, I'm going to ask you, as an individual, or as an individual or as a high net worth individual, what should you be happy about with these tax acts that we have? What are the things that should make you happy? I know you had earlier mentioned the capital gains, right? Especially when it comes to private residency. But what are the other things that you should be happy about? Or is just to say, okay, you know what? Everybody needs to go back to the drawing board, and we now need to start understanding how we treat A, how we go to B, and all that. Then also aligned with this, holding assets now as an individual versus as a corporate entity, are there any distinctions for taxation purposes that you can share with us?
All right, thank you so much. In this new tax regime, even as we have, it's favor the low earner more than the high net worth individual. But despite that fact, we still have some incentive for the high net worth individual. One of the incentive is economic development incentive. That I'm talking about corporate, because it is from the corporate world that translates, that is a corporate world that make an individual to become an high net worth individual. There is no personal business you want to be doing, except probably you inherit a lot of property from your parents, or you inherit some kind of goodwill or some kind of gift or charitable property. But when it comes to rising to the level of high net worth level, then you have to build it from your corporate world, that is your business or your income. So, for example, one of the incentives for the high net worth individual, which can be derived from, which they can leverage on by through their corporate organization, is economic development incentive, which was known as pioneer status before. You have the opportunity to have tax-free or tax holiday for 5 years, and after that expiration of 5 years, you can have another renewal of 5 years, so long your business plays within the priority sector, such as agro and agro-ally, health sector, renewable energy, and the like. Then for an high net worth individual, if you go into real estate, the law says that the interest on the real estate is tax deductible. This is to encourage a lot of people to have their own houses and to put money into people's pockets. So generally, the new tax system actually target the high net worth individual, because majority of them doesn't pay. For example, I had an experience last year. I discovered that EFCC work in collaboration with FRS, NRS now. So what they do is to look at the accounts of the high net worth individual, and some of them will be running business running into billions of naira, and they can be running it through their personal income, or they may be running it through their corporate of the company, and yet they are not paying either company income tax or commensurable personal income tax. So basically, for an high net worth individual, it depends again on where you channel your investment into. There are some investment, if you channel it there, and over the years, probably you are rolling it over and over and over. You may be keeping it there. And at the same time, for an high net worth individual, you are asking whether it is good to use corporate body for the investments or personal or individual accounts. It's better you use corporate, in the sense that, number one, corporate is a legal entity. If there is anything that happen, maybe in case of a professional, maybe you default, maybe there's a legal litigation issue, before your personal asset will be touched, the corporate organization asset will have been dealt with. So it is always advisable for an high net worth individual to use corporate or special purpose vehicle to manage and to warehouse their investment, rather than using it on their personal or individual accounts. Thank you.
Okay, yeah, thank you so, Mr. Ino. So this really, I mean, the example that you had, okay, so I think this is becoming mainstream. That's what I would say. When I say mainstream, everybody is getting to know that these things exist, or these practices exist. So practices where you have the revenue agency and the economic crime agency going after people, having access to your bank details, and calling you to make clarifications with respect to how you came about this asset or this funding, or this thing was linked to you. To a large extent, you could say before now that it was probably those that were affected, or those that had issues or life issues, or those that have been invited, that would say, oh, these things are real and they happen. But with what we've seen right now, with the way the tax acts, the sections and the provisions, it's going to become more mainstream. And you could see that initially at the start of the year, there was a lot of anxiety with people saying, oh, the government is going to go into your bank account and they will debit your tax and they will do this. And there was a lot of people saying, no, that's not what will happen. This is what is there. I mean, some people woke up early January and said there was a VAT on
Yes.
there's not a VAT on transfers and everything. While the government has tried, the Nigerian government has tried, especially to kind of counter these reports, the bottom line is that that is the reality that the Nigerian citizens are facing. So when it comes to being anxious or having anxiety with respect to your tax exposure as an ordinary Nigerian citizen, anyhow you'd go about it. If it's your 10,000 naira transfer that you want to do, out of that your 800 naira income, 800,000 per annum, you want to do your 10,000, you will still be charged VAT of on those transfers. So invariably everybody is paying up their tax liability one way or the other. But what would you say to individuals? What would you say to people to just say, you know what, calm your nerves, don't be anxious? What would you say they should do? So if you could list like 3 to 4 things that an individual should do, whether a low income individual, a high net worth individual, or corporate, that they should do with respect to what is before us right now with the tax regime and the tax system, what would be those 4 things that you would advise them to do?
All right. Going forward, there's something that is known as JRTB, that's Joint Revenue Tax Board or Joint Revenue Board. The essence of establishing that board is to be able to share information within themselves. So state is collaborating with federal, and federal is collaborating with the state so that information can flow seamlessly. So to tell us that there is nowhere anybody can hide. For example, if I render my tax return to Lagos State or to NRS, Lagos State can approach NRS for my detailed account file, and they can extract whatever information they needed in order to be able to reassess me if they are not satisfied. So for people that are apprehensive that government or NRS or whatever authority will just go into the account and deduct tax directly, no, it doesn't work like that. Government will never, or tax authority will never go into your account and debit it for tax purpose, because there must be a thorough explanation and declaration of whatever inflow that have gone into that your account, either in form of self-assessment or in form of audited financials, and your tax computation can be well declared. So the issue of government will just go into my account and debit it, no. Before government has rights to do that, but before they will do such a thing, there must be maybe an invitation, a liability will be established, and when they go to the level at which they have arrived a dead end with you, there must be a court injunction to give them the right to be able to debit your account. But before they will get to this level, there must be an invitation, a notification. You will have done whatever you need to do. But if you ignore and you did not take any step, then government, at the end of the day, when they get an injunction against you, whether as an individual or as a corporate entity, they have the right to debit that account. And beyond that, they have also the power to go through third party, either your clients or other agency, especially the bank, to do that. We saw it happen during the days of Fowler, when liens was placed on corporate accounts or even individual accounts during the VAT declaration. But for those people that declare their VAT, they were exempted from accumulated penalty. They only paid the principal, and nothing was done to their account. So what we need to do going forward as an individual or as a corporate entity, number one, you must play transparency, proper documentation. Number two, you must also be able to have a good consultant that can give you proper guidance. I tell people, for example, if you don't file your VAT, the law says for the first month is 100,000 naira, subsequent one is 50,000. So in a year, that is 550. The same thing is applicable to company income tax. And shoddy documentation too goes with its own penalty. So at the end of the day, in a year, if you fail to comply, you will have accumulated a lot of penalty in millions. But if you do proper filing as at when due, you will discover that probably if you fall under small company, you will have nothing to pay. So the very first one, proper documentation. The second thing, have good consultants that can guide you. The third one is timely filing. Timely filing is key. Then the last one is you must, for example, a corporate entity, adjust your system. Adjust your system for especially companies that are using software, highly technological driven. Adjust your system to comply with the new tax law. Thank you.
Okay, Dr. Yika, do you have comments that you can share with respect to this? What do people do? What do individuals do? Whether you are a low income earner, you are a high income earner, you are a small business, you are a big conglomerate, multinational, what do you do? Because there has been so much anxiety that has been that just about everywhere. Um, Recently you had the Lagos State LRS, just like what Mr. Aino Tunji just said. There is the cooperation between states, and there's also the cooperation that is facilitated between the federal government and the state. So there is the board where everyone meets, the joint tax board, where everyone kind of sits and they kind of, so there's that already internally, that share of information and positioning. Then if you look at what the Lagos State put out, some Lagos State Revenue Agency put out some couple of days ago, you will find that, like, just like I said, there's really no hiding place. It's an area of transparency. How do you bring, what do you do? How do you say, you know what, everyone just calm down, you don't need to be anxious, these are the steps that you could take. So if you were not doing this before, this is what you should be looking to do across all the different entities, individuals or entities that the new tax regime applies to.
All right, so thank you. Thank you for this. I also want to appreciate Mr. Ino for at least shedding light on all of those issues, the administrative process that has to be followed before government will be able to, even if that is, I mean, government will be able to debit your account or whatever. I mean, that is actually an extreme situation, right? So I was in a forum recently, I think this weekend, and for the first time, a number of people said to me that they never knew anything about self-assessment and administrative assessments, or what we call government assessments. So they don't know anything about it. So, and for them, it was a big relief, right? To know that, oh, I don't even need to fret. I don't need to be too anxious, right? That, oh, the little money I kept, in the Gen Z language, my OGen 2K, will be tampered with, right? So, so nobody will tamper with your OGen 2K, really, except that OGen 2K is actually, even if it's a tax that income you've earned, from your business or from any other source, what government is expecting is that you will be honest enough. Even the Constitution, which is the grand norm of the country, I think Section 24 is clear that you should declare your income and pay your taxes, right? So it's a civic responsibility. So it only becomes a challenge where you are not declaring it, and again, you're not paying anything. It looks like you are shortchanging others. And that's the example I gave to them that day. I said of course, a number of people, those, especially those that are under one employment or the other, they are compelled to pay because, of course, the payee mechanism is there. So they are their taxes are actually deducted at source and before paying them, right? But for all of you that are all of you that you are into, you're an independent professional, you are a content creator, you are a self-employed person, so what contribution are you also making, right, to the society? So you complain about this and complain about that, but again, what are you contributing? That road that you drive through, and then you hunt for the next person in front of you to clear out of the way as if the road belongs to you. If they ask you what is your contribution to the construction of that road as a resident of Lagos, right, or to the maintenance of that road, what did he contribute? At the end of the day, he didn't contribute anything. Right. So those that are working seem to be unfairly treated, so to say. Look at, so that is why the law is trying to say everybody has to contribute, and that is how we will be able to develop. Now, and also tell people that it's even easier to demand for accountability, right, when you are contributing. You can actually walk to the office of your local government chairman and then show him, this is what I've contributed for the whole year. This has been deducted from my account. I filed my returns. This is my contribution to this local government. So what am I getting in return? Right. So it makes it easier for you to demand for such accountability, right? Which has been always a challenge here in the country. So everybody, what the government is trying to do now is ensure that everybody at least pays their fair share. So there's no need for being too anxious or too scared of what government is going to do. All you needed to do is to make sure I tell people, okay, let me even say a bit of what happens. I saw some comedy, skits and all over the place. People trying to talk about narration, right? So a lawyer calling someone say, please, that's that's my legal fee that I want to pay me. Don't write legal fee there, so right.
Right. Call medical expenses.
Medical expenses. I saw that, I was just laughing. So it's not about even the narration you give to it, right? It's not even the narration you give to it. So it's about the actual what that income is, the character of the income. What is it? So if so, should be able to prove or substantiate whatever it is that you have in your account, for example. Now you are using. I was telling somebody that somebody is um, okay, it's a small business. It's also important to separate your personal money from the business money. It's also very important so that you can justify with documentation how you earn whatever it is in your business account, right? There are invoices there for each transaction. There are contracts you signed. You must keep those documents. This is no longer the era of doing things, anyhow. So you need to be able to be conscious of the fact that your protection now is actually those documents that you actually keep, right? And also bear in mind that those documents, there's also mechanism to also verify those documents to ensure that those documents are also not forged. Again, if they are also forged, there are also consequences for forgery, even including imprisonment. Of course, in the law. So it's important to bear all of this in mind. So when you know all of this, it makes it easy for you to do the right thing. So you don't need to fret. Just make sure. And again, I also want to add something very important. Maybe for those that are, of course, this affects almost everybody. Whether you're a professional in the what I call the brick and mortar space, or you're operating in the digital economy, right? Let's say, for example, those that are into, uh, let's say, social media influencers, for example, they have built a level of followership or engagement on social media, and they now become like brand ambassadors. They are now promoting certain brands. So the law has also introduced a section that was not existing before, right? Or a provision that was not existing before, Section 100, subsection 2 of the Nigerian Tax Administration Act, has said that if any company, anybody, it could be company, it could be any, awards a contract to another person, right, that is not registered for tax purposes. So you are giving a contract to somebody, the person is not registered, there's no evidence that the person is in the tax net, that you will be exposed to the fine of 5 million naira. So that is also not just about compliance, it's even about business. So government has pushed you, because again, it means for you to get that endorsement, you have to make sure you register for tax purposes. So because the person, for example, take the big brand that wants to give you an endorsement, will not want to throw away 5 million. So they would rather give the business to the person that is compliant, right? So government is tying the various actors together to say, look, the days of fragmentation is no longer going to work. So we're going to bring all of you together. So if you are, and again, if you look at subsection 1 of that section, that's section 100, subsection 1, you also see a provision there saying that if you're not registered for tax, for you don't register for tax purpose, for example, you are going to also be exposed to a penalty of 50,000 in the first instance, the first month, and then 25,000 for subsequent months. So that is also telling you that it's also the era of, so for big brands now, they are more focused on people that are compliant. So if you can have all the followers on Instagram, but as long as they are not compliant with this thing, they'll be more, they won't be ready to do business with you. So I mean, that is also for those that are, and this also applies to other professionals, right? So if I want to engage a lawyer, if I'm a big brand, I want to engage a lawyer, as a for anything, I'm also ensure that the lawyer is registered. So that is also another way of I mean, that you should just have to have in mind as we go. So it's just about doing the right thing, and then I mean, going to sleep rather than thinking that you want to hide, because the era of hiding, like you said, is gone, so to say. So there's a lot of transparency requirements at this point.
Yeah, thank you so much. So that means that each and every one of us, for as many of us that are Nigerians, those of us that are on the call, after today, let's make sure that we get tax, that we are registered. We have our TIN, our tax identification number, or find out what has already been assigned to you, because already there's the understanding that the if we given the requirement for everyone to have the national identification number, that national identification number is already attached to a TIN. So it's just for you to go find out. Then for corporates as well, at the point of your incorporation, you also need that. I mean, everywhere there is transparency. The bankers cannot open an account with you, whether as an individual or as a corporate, without having your TIN. So they might have it, and you probably might not be the one to supply it, because they know how to access it. Once they have your number and they have the requisite documents, they go to the registry and they can access it. So they might not even come back to you that they have it. So if you have your financial advisors, your stockbroker, your registrars, your your bankers not asking you for this, it doesn't mean that they don't have it. But if they do ask you, they are probably just being cautious to you, because there is a registry already that is available, where all these things, where this can be assessed, and they can be assessed for legal purposes. So get the tax registration done, have it, know it, and get your documentation. So if it's a revenue, there has to be a trail, a paper trail that says, okay, this is a revenue. So it's not a case of skits telling us that, you know what, I don't care whatever my services are to you, or whether I supplied you 100 bags of rice. Go there and put there that is medical expenses. How many medical expenses would you have month on month within a 1 year period? So documentation is everything. And besides, taxation is on revenue, is on income. It is not supposed to, you are not supposed to tax poverty. So the whole idea of how we go about our tax, and the mentality we have with our tax compliance, it just has to be do the right thing, and ensure that those around us also do the right thing. So Dr. Iyika, go back to our digital content creators. all those that will tell you that I mean there's a lot of people that will tell you that that they don't work with Nigerian time. The way they wake up and they rise up and they do their work is not Nigerian time, because they work in other jurisdictions. I know of certain cases where the human resource people who have been approached by other global firms were not able to onboard Nigerians for some particular kinds of work because of the opaqueness that we had around our tax, remittances, who do they pay. So you just find out that when you tell them that, oh, these candidates, excellent candidates, fantastic candidates, but just because they are Nigerians and the opaqueness that comes with whether the tax obligations, whether it's there are some countries that you don't have double taxation treaties with, but does that tax treatment, how would they compute for this Nigerian employee who would probably be based in Nigeria but will be working for them? How has the tax act come to help to provide clarity? And how will these revenues, this income, so for such companies, what relief or what simplified processes are now available such that local talents can now be sourced to provide services globally without that opaqueness, without people saying, oh, are you from Nigeria? We don't understand how you guys work here, and all that. So what has the Nigerian Tax Act done to kind of create a very good platform for local talents to be exported offshore?
Okay, so I think to respond to that, the framing of the tax law is actually mindful of every category of individuals, right, or corporates when this frame was done. So for those, of course, what you're referring to is remote work, right? Yeah, for those who work for different brands from home, and of course, there are different ways that this has been, addressed. Even in the past, even before the reform, we've always had. Again, you must also let me also say in this way, in this side, that first of all, when it comes to personal income administration, is majorly within the purview of the states. For example, yeah. So those in Lagos states, or maybe Mr. who perhaps as maybe one way or the other don't stop relating to that, could probably give us a more practical perspective. But my understanding is that, of course, every individual lives in a state, right? Working in Nigeria, you based in Nigeria, working in Nigeria, you based in Nigeria, working for another entity outside. You're actually resident in the state, and then the rule is still the same. It's about residency, right? So, whatever income you've generated from all sources, you're supposed to file a return on that. But again, for the employers of those people, in terms of the weakness you're talking about, for other form of, but this is now more like exporting services, right? For in supply of services, for example, let's say the supply of those services is outside. We've been able to address that by making the supplier, in this case, a non-resident company, the agent of collection for tax purposes, right? So, but in this case, for export of those services, I think the law has also been able to recognize that your income, as long as this income is derived in Nigeria, even though the person you're working for is outside, but again, you're doing all of the work you do. So the commercial activities that give rise to that income you're earning, right? Or let me say, when I mean commercial, the efforts that or the whatever you're doing it remotely, but again, you are based in Nigeria. But if we're talking about on a broader perspective, let's say we're looking at taxability. If what we're talking about, for example, is taxability of the entities that are that employ these workers. So, recently the OECD, I think towards the end of last year, when we say the OECD seems to be or is not just seem to be, is the body that actually provides a more authoritative rules or guidance around taxation, especially cross-border taxation, when it has to do with multiple countries. So the OECD has said that if, for example, you have a worker working remotely, because what is going on now is that, and I'll come back to what the OECD says, what is going on actually is that most of the laws that we have did not envisage this situation. Yeah, that's the reality. So most of the laws we had didn't envisage a situation where somebody can sit in one country and work in another country, right? The law did not envisage where somebody can be in another country and supply services to another country. So the internet age and the digital revolution was not there when most of these laws were made. So even the OECD at the global level is just still amending its guidance towards the end of last year to say that if a multinational, for example, that is based in, let's say, in the US, has an employee in Nigeria and provided a space for the employee to work, and then decides when the employee resumes and when the employee closes, and even has more like pays the rent for the space and does all of that where the employee uses, that space has created a taxable presence for that US company, right? That's what the OECD has said. So it has created a taxable presence for that US company. So the US company is supposed to pay tax on the income that is whatever it is that it derives from that activity. So this is just saying that, again, our own system is evolving. I also believe that there's going to be a number of guidance that will be issued soon, both from the NRS and the states IRSs, to be able to provide more detailed guidance as to how these employers of youths that are working remotely will be able to administratively pay their taxes that are due on those employees. So I think that would be my comment on this.
Okay. Mr. Aino, please, what are your comments on this, especially with the digital realities that we have now? People are here in Lagos, they are here in Ogun, they are in Anambra, they are in Imo, and they are doing fantastic work, supplying services to other countries, and they don't need to leave their home country. They don't need to get on the plane. They just have the internet connection, whether you use the local ones or you use the international internet connections, the ones that you get with Starlink and all the likes. So how has Nigerian's tax act kind of envisioned this new reality, and what should individuals or corporates, whether locally or internationally, what should they be aware of given this reality?
All right, thank you so much. Doctor had really done serious justice to it. But looking at the current tax act or law, the remote worker or income from remote services, there is no express guideline as to this specific area. I stumbled on a particular documentation, but I will still need to go and do more research as by it. For example, if you look at Lagos State now, for an individual that is not registered with LRS and is not working under a registered company, is just doing it on personal basis directly, and they pay directly to his personal account. So that individual, it will be so difficult for such an account to be taxed, except maybe what is going through the account is heavy, and there's a trigger and a surveillance is being placed on that account to scrutinize the revenue and to take the tax element. But for me, what I'm looking at is this. If a service provider is engaged by foreigner, when they are about to pay from their pay point, they will deduct withholding tax. So having deducted withholding tax, so if the balance comes to the account of that individual, if it is being taxed again, then it becomes a double taxation. I want to believe that guideline will be rolled out, especially some gray area. But if I work remotely and when I'm being paid, they have deducted withholding tax over there, then the question is, should the resultant, the balance, be taxed again? Then it will amount to double taxation, because what they have deducted is tax paid in advance, and they have the right to deduct because they are the one that outsourced the job to me. And when they are to pay me for my professional services, they're supposed to deduct withholding tax. So, but if they deduct withholding tax and they remain there and I'm not staying there, of what benefit is it to me? Then if government tax me again here, then it amounts to double taxation. But for now, there is not an express guideline as for these remote workers. But I had an experience, one of our clients, okay, you will know her, consulted for a particular training school in abroad, online, remotely. And when they were paying her that dollar, so it's a pass, they have to deduct withholding tax. So she consulted me that what they have done is it right? I said it's okay because the job is an outsourced one and they have to deduct withholding tax. And since they have done that one, if it is a country that has a treaty arrangement agreement within themselves, whatever that comes to you should not be taxed. That's another area we need to look at. If there is no any tax treaty, probably what comes to the remote worker in Nigeria will be likely subjected to taxation if there is no tax treaty to avoid the double taxation matter. Thank you.
Okay, Dr. Yika. What I was going to say to that was just the fact that maybe we need a lot more clarity, because there's a lot of moving parts here. You have the countries, and you have to know, okay, do they have, how would tax apply? Would it apply based on residency there, yeah, and of what benefit and all that? So I know that there's a lot of moving parts when it comes to remote work, but it's just the fact that there is really been a lot of issues of fantastic talents here not being able to have very good placement because of the reservations that the companies themselves, the offshore companies, the overseas companies had with onboarding Nigerian citizens, because they just didn't understand a whole lot of things, especially the tax element. So we are hoping that we'll have further guidelines and clarity around this. But Dr. Yika, just going back on this same digital assets, we've had the SEC, that the Securities and Exchange Commission, define what digital assets are. We know them as your cryptocurrencies, your tokenized events, your blockchain activities that you do and everything. Then we also know that there are people that also operate and earn digitally as well, the content creators, the different platforms where you make sales and you earn. whether you're advertising on, whether you are making sales on Meta platform, whether you are making it on Instagram, whether you are making it on any of these social platforms. So how has the new tax regime affected either the ease, the simplicity with which corporates or individuals can be able to know that, okay, if I'm operating within the digital space, I either have a digital asset or I'm operating within the digital space, that this is what my tax exposure would be. Has that been simplified or has that been clarified for us in this new tax regime? Dr. Yika, are you there?
Yeah, I'm here.
Okay.
Yeah, I'm here. Sorry. So I think if I get you correctly, you're asking what the reform has done with respect to
Yes, exactly. Yeah.
those operators. Yeah.
Yeah,
So
yes, how it has impacted it. Yeah.
yeah. So generally, like I said, you either operate. I mean, of course, the segmentation for both businesses and individuals is still the same. Whether you operate, I mean, the legal structure now is still the same. You're operating as an enterprise or what they call business name, or you're operating as an individual. I mean, or you're also operating as a corporate entity. All of that also, of course, will always determine what your exposure is. So when it comes to digital uh, or e-commerce businesses, so e-commerce business activities, whatever it is that you do under the using any platform, will always bear in mind that, of course, you're still going to prepare your accounts or your profit or loss to show what again you've been able to generate from that activity. So the when it comes to let me just say a bit of what happened even before this holistic reform. Nigeria has done a whole lot with respect to the digital economy. So there's really nothing so much that happened within the reform. Okay, a lot has been. Remember, before the reform, there's been a lot of finance acts. So there's been a lot of finance acts starting from 2020 or 2019 finance acts up until 2023. So we've always had finance acts. Those finance acts came up with a lot of changes within the digital space. Of course, recognizing the fact that businesses have shifted from the physical to the digital. All right. So now, for example, one of the changes that happened in 2019 was to say that if you are a supplier, because we looked at it from suppliers of digital services into Nigeria, right? This is because the biggest channel of tax avoidance or biggest channel of profit shifting has always been cross-border interactions. Yeah, so if you are in the economy, for example, dealing with each other, there's always a way to get. Government always has a way of tracking and exchanging information internally. So I mean, you mentioned it earlier, and Mr. N also mentioned it through Joint Revenue Board, and even before Joint Revenue, there has been JTB. There's a lot of collaboration that is happening right within. But again, where the challenge when it comes to digital economy, the real digital economy that we'll always focus on to a large extent is those doing business across borders, right? Especially when it has to do with supply, because Nigeria is largely a consumer economy, right? So we consume products, physical products, we consume digital products and services. So on that point, from that point, in 2019, there was an enactment that introduced what we call significant economic presence order. So that order kind of mandates suppliers of digital services. It could be the likes of Spotify supplying music, live streaming, or I'm sorry, music streaming platforms that you subscribe to. So all of those people, Netflix videos, streaming platforms, and all of those platforms, Meta, even the cloud services providers like Amazon, all of those people provide one service or the other to Nigerians, right, operating in the digital space. So they have been mandated to pay corporate income tax as long as their supplies for a year, is up to 25 million. So if you're supplying services to Nigeria and end up to 25 million, you're expected to pay corporate income tax. Now, for value-added tax, again, there also is a subsequent amendment that also mandates them also to charge VAT on those services, because again, we know that VAT is on destination principle, right? So from that 2019 up to now, as we speak, a number of them are in the tax net. They are paying taxes, both the VAT and corporate taxes to Nigeria. They have been complying, again, largely complying, those in that digital space. So, because even at the global stage, when you hear digital economy, that's what they're referring to, not people using maybe online to connect to their customers to deliver goods physically. So for example, if I have to, if I run a restaurant and I use a platform to connect to my customer, the guy, and I use a logistic, let's say a rider to dispatch it and all of that, you will not be completely categorized as a digital, fall within the digital economy per se, right? Because the entire thing has to happen end to end. So if you're looking at Netflix, for example, it's end to end, right? So everything is end to end within the app. Everything happens there. So that is more like what we when you hear digital economy within the tax space, that's where the focus really is. So because the other ones, of course, you have to have it. If you run a restaurant, ordinarily it's easy to track you to your where you do all of that. So, but if you say, for example, those ones are the Netflix, for example, is a non-resident company. It's situated elsewhere, right? And then again, it's supplying services end to end to Nigerians. So again, though there are still a bit of challenges, especially when it comes to B2C. What I mean by B2C, because if you're operating within the e-commerce segment, you have what we call B2B and then B2C. So for B2B businesses, of course, the law has been simplified to say, look, if, for example, Netflix you pay your subscription to Netflix, right? The invoice, of course, Netflix invoiced you. So Netflix is supposed to include a VAT to the total amount you're going to pay. So when you are paying, right, for business to business, right, so the business is expected to deduct that VAT and remit to government, because the VAT actually is not for Netflix. It's Nigeria, because the consumption of that services was done in Nigeria, and the people that consume the services are in Nigeria. All right, so that is in place. But where we have challenges, business to customers, B2C, for example. So individual, this is at individual level. So be able to coordinate individuals to be able to be deducting VAT and remit it to government is a bit of a challenge, which I believe further provisions will be done to be able to tighten those ends. So, but largely, we're evolving. I believe, right? Even the reform that we're talking about, and I also believe in no distant time, there's also going to be the need for also to take a look at it to see, okay, are there things that are coming up that we need to look at? Are there things that we need to review? Are there things to also? So I believe that will also happen going forward. So
okay, thank you so much. Yeah. Thank you so much. I'm just going to ask you some questions. We are short on time, so we need to move a bit faster. I think we've delved into a lot of the things we wanted to talk. Non-residents, whether as a Nigerian, whether as a corporate entity, you need to have you would be deemed if to do the needful, register for tax purposes, and as a Nigerian, if you're not paying tax offshore, then for whether you're using the residency for whatever purposes, you have to make sure that you comply with our own tax obligations here. So whether you are an overseas company or you are a Nigerian or you are an individual. But let's quickly, we've dealt about digital assets, the digital economy, and we've also talked about individuals, businesses, corporate families, and all that. The one that I want us to now look at is trust and estates. And I have two questions for you, Dr. Yika. Offshore trust, ordinarily, and I know that you are an expert here, they face a presumption. There is a presumption of tax avoidance, or you could say tax evasion. I don't even want to call it avoidance, because avoidance just means that you're working around the ambit of what the law either doesn't bring to the fore, or is not asking you to do, but you can plan around it. But tax avoidance, tax evasion. So offshore trusts have this label that they are very good havens for tax evasion. How has the Nigerian Tax Act brought into for trust and such structures for individuals or families, and especially for the NRS, the Nigerian Revenue Service, and what you need to disclose to them, given those structures that you have as an individual. We also know that the Act also has a look through. So we call this a look through provision because it is a rule in the Act that taxes settlers who still maintain effective control over their trust assets. So how does so in your own view, how are trusts and estate planning and all that goes into it, how are they brought to light, or what are the measures that the government has done, and what are also the things that the people that use this structure or that want to use this structure, what confidence should they have in using this structure such as trust?
Sorry. So I said you've said it all. Um, yeah. So I mean, this is even the heart of the whole stuff. You said it all. That is, it's there's a general perception around the use of trusts, for tax avoidance, and even sometimes aggressive one at that. So there's a thin line between aggressive tax avoidance and sometimes tax evasion. So there's a thin line. Even though we say tax avoidance is legal, tax evasion is not. All right. But when it becomes too aggressive, especially like the use of trust and other vehicles, so it's even deemed to be evasion. All right. So the reform, like you also pointed out, has made the opacity of trust, has I kind of dismembered it, so to say, such that it is now going beyond. We're not going beyond just looking at the trust itself, but looking at even those actors within the trust. For example, like you mentioned, where the settlers are controlling and also benefiting. So income generally will be attributable to them, unlike what it used to be. All right. So if you look at the whole idea around this is to ensure that uh, those vehicles doesn't continue to become conduits for profit shifting or for evasion, right? Because if you look at, I don't know, of course, you are aware of the various, I would say, corporate tax scandals that has happened in the past. Things like the Panama leaks. You've heard of the Pandora leaks. You've heard of the I call them the three Ps: Paradise, Pandora, and Panama. Right. So those are actually usually associated with the use of trusts, right, to build very complex and complicated structures that you cannot even see through and know who are the beneficiaries, who truly is behind those vehicles. So, and that is what government is also trying to have some level of visibility into what happens. So, this is also, we can link this to what we call the beneficial ownership register, which I mentioned earlier, that even a lot of push by the global community to ensure that high net worth individuals no longer continue to use all of these vehicles to shield. They are usually used as shelters, right, to shield themselves from paying taxes. So, and that is why there's increased pressure on ensuring that countries comply. In fact, the Global Forum on Transparency and Exchange of Information, which is an arm of the OECD, has a way of doing what they call peer review of countries that are compliant. And the NRS for a long time has been working together with this particular organ of the OECD, which of course periodically try to check to ensure that the various high net worth individuals that's operating, that their income is actually subjected to tax. Because a lot of them are actually outside the tax net, living the middle, if there's anything like middle income or middle class, and then the poor people to be the one facing the brunt. So I think that's what the law is trying to do. But so it is no longer, it's no longer news that, like we said from the beginning, that no hiding place any longer, even including trust, which has always been I would call the rock of ages, where you can always hide in the past. Because when it comes to taxation of trust, it has always been a challenge globally. I'm talking about a global challenge. So, but again, there's increased demand to make it more transparent and see through, like you call it.
So what is the comfort to Nigerians? What is the comfort to individuals seeking to use these structures, or even the existing ones that they have?
Yeah, so what I was saying is that I said the law is, I mean, the guidance we are expecting I believe will be out soon, whereby we'll be able to see clearly what the people that have this kind of structures are expected to do going forward. Right? So the law, the provision, the framework is already there, right? But again, the details on how they will be expected to comply, I'm sure will follow. So both from the individual state internal revenue services and as well as the NRS, so that nobody will say they are not aware of what exactly they do. Because an efficient tax system will always ensure that the taxpayers are educated and properly guided, so that nobody runs foul of the law for lack of want of, or for want of what to do exactly. So thank you.
Okay. So yeah, the final question to you would be with respect to philanthropy. So for people that have philanthropic initiatives, or either they have existing one or they are planning on setting up a new one, are there any benefits under this tax act that they can rely on, either as individuals or as corporate?
Okay, so yeah, so to my mind, I would think that you are referring to, let's say, those that use foundations, for example.
Yeah.
Yeah,
So yeah.
it's like foundations
Mm.
and donations.
Donations, yes. Donations, yeah, charitable initiatives and all that,
Charitable
yeah.
initiatives. Yeah, so I think basically what the law tries to do is to ensure that whatever body you are donating to, right, is of public character. I think there's also that focus on that, because many people have also used in the past as tax planning tool, to create foundation here and then move money, because of the law has said that donations are allowable deductions, right? So they will rather create one foundation or the other and then push money to that particular foundation, and then of course that is allowed to go as a tax deductible item. In that case, totally crashing down their tax liability. So the law has said, okay, it has to be able to, that area is not just no longer open to the way it is, or open-ended. Of course, there are certain requirements that, of course, you also have to meet, which is one of them is to ensure that the particular body benefiting from that is what I say public in nature, public in character, is that is not that the same foundation is also traceable to a private business or a commercial venture. So if you are donating to, for example, yes, let's say you are donating, for example, to a public school, for example, right? The government public school, for example, that could also be understandable again. So, and some other areas you could also look at to donate to. But when it's observed that that donation is actually not, is also another way of pushing profit, because the whole idea is to ensure that there's no loophole where you can take advantage of to undermine the tax codes. So yeah, so that would be my comment on the issue of donation. For if your objective is to donate to contribute or to do some corporate social responsibility, right? Of course, that is also not a bad idea. The law, there's not so much. The law doesn't prevent you from doing that, but again, you have to ensure that you're not doing that to actually undermine for tax purpose, maybe for tax planning purposes. And I also forgot to add that there's also a new provision introduced in the tax law. I think the Nigerian Tax Act, if I'm not mistaken, that requires that corporates disclose their tax planning arrangements. So it's no longer the era you do tax planning. So you have to disclose exactly what you are doing and why you are doing it, right? So that's also one thing I needed to add to this.
Yeah. Very, very important. We're going to mention that, yes, that really the law has put the onus on the taxpayers to disclose their transactions. So how you structure your tax savings, or how you structure your tax planning mechanism, and how you go about it. The onus is now on you to kind of explain that. Um, it's really an era of transparency, and and no hiding places. Okay, so Mr. Aino, we're just going to ask you two questions so we can round up. Um, how has this tax regime impacted on VAT, value added tax payment, as well as withholding tax for both individuals and corporates?
Okay. VAT rate is still the same, 7.5%. There's no increase, there's no decrease. But what the government have done is to increase the exemption list. And there's something we call zero-rated goods and services for VAT purpose, and we have exemption. So the two, if you look at it, zero VATed, exemption. So when you exempt something, is zero, but the real applicability differs. For a zero VATed or rated VATed item or goods, says that they can claim VAT outputs, but for VAT exemption, you can't claim. You will not charge VAT, you will not collect VAT, and you can't claim VAT output. So for zero-rated VATable item, they can claim VAT outputs, even though they did not have VAT inputs. So the government has expanded and enlarged the items and goods that qualify for VAT exemption. And it is important and compulsory for every organization to charge VAT. But the law says that if you are a small company, before we have small company, we have medium and we have large. But now the gap has been bridged. We have small company and large company. So if your turnover is less than 100 million, you are a small company. Then it is, if it is up to 100 and above, you are a large company. So for a small company, you are not supposed to charge VAT. But if you are dealing with a bigger organization that are qualified to be paying VAT, you have to charge them VAT and remit. I want to repeat it again. As a small company, you are not supposed to charge VAT nor collect VAT. But if you are dealing with maybe multinational, you are dealing with a company that has a high volume of turnover, then there's nothing stopping you from collecting VAT and remitting.
There's a question by someone. Worldwide income applied to a holding company transfer. I'm thinking that it says that would a worldwide income apply to a holding company transfer to an operating company in Nigeria, for example? For one reason or the, I think what has happened here is that there's a link that is attached to my name that must have
All
gone
right,
round
I'm back.
people.
I'm
Okay,
back.
okay, sir. Yeah, so sorry, Dr. Yika. So let's quickly conclude on the VAT exemption, zero rated, and what are the items, example of those items, and also how they how withholding tax impact individuals and corporates. Okay, over to you, Mr. Aino.
All right, so let me move to withholding tax. Withholding tax is tax paid in advance. What government has done in their wisdom is to make sure that no one escape tax when you are qualified to pay tax. So once you are qualified to pay tax, government make sure that they collect their tax in advance. So withholding tax, there are taxes paid in advance, whether as an individual or as a corporate entity. So as a corporate entity, the law says if your turnover is not up to 100 million, you're exempted. So once you issue your invoice, before your clients will pay you, they will have deducted the withholding tax, and we have different rates for each items. For rent, it's 10%. So as a landlord here, if you are collecting rent, especially on corporate property, your invoice or your receipt will suffer 10%. So that 10% being removed will be remitted to NRS because it's a limited organization. So for every withholding that you have suffered, as your client is removing it, they will remit it via tax promise on your behalf. So at the end of the year, when your audited account is prepared to determine what you actually need to pay as a tax liability, there will be a net off of what's supposed to pay and the available withholding tax credit note. So if you have enough credit notes above the tax liability, then you will not pay cash. Then you still have credit to your withholding tax account. But if your liability is above the available credit notes, withholding tax credit note, then you will deduct it and the balance will be paid by cash. And if you are an individual, your withholding tax will be paid to your respective state internal revenue by using your payer ID. And at the end of the year, when your direct assessment is being worked out, then you knock off the withholding tax that you have suffered on your invoices, and the resultant is what you are going to remit. So we need to understand the withholding tax rate, because if you don't understand it, at the end of the day, when government comes for tax audit, they will ask you to pay. And there is another thing that came up, especially for corporate organizations operating in oil and gas industry or sector. We have VAT on expenses and VAT. Withholding tax, even withholding tax on expenses, VAT on expenses, and we have withholding tax on your invoices. All right. I think let me just rest my case here.
Okay, that's fine. Thank you so much. Yeah. So so we do understand that that there are exemptions to the VAT. Unfortunately, our 10,000 naira and above deductions are subject to VAT. But yeah, that we have some exemptions. Then we have zero rated VAT. Then we also have the withholding tax. And I think there's been clarity that if an individual is making payment, there is no liability to withhold tax when that individual is making payment. But for corporates, it is a whole lot of other. You would have to make sure that you withhold the tax if you are dealing with a corporate entity, especially or a corporate entity that is dealing with an individual, because it will come because you can net it off either as an individual or as a corporate. Okay, so we have some questions here. I just wanted to make sure that we go through those questions. So, Miss Dr. Yika, if you are still with us, if you want to take the questions, that would be great, and we can just quickly round up in another couple of minutes. Another 10 minutes from now, we would round up. So, I think you should just ignore this because I think it's a link that originated from me, and it seems that a lot of people came in from that link. So, it says would worldwide income apply to a holding company transfer to an operating company in Nigeria? For example, I don't know if there is a way with which we could rephrase that question, or if the person that asked this question is still with us, if you could raise up your hand and we will give you access to be able to ask your question. So, Dr. Yika, we have that. Then another question is, what if you make a loss on your overseas income? Can you claim a relief on the tax you pay back at home? That would be in your home country, Nigeria. The another question is, the new tax law comes into effect this year. So does that mean it would affect income made in 2025? Is my understanding correct? That is, if an individual is making tax return later in the year. So, Dr. Yika, please, if you don't mind, kindly help us with your responses to this question.
All right, so I think I will start with the last one, which is saying that the new tax law comes into effect this year. Do that mean it will affect income made in 2025? Is my understanding correct? If an individual is making tax return, so of course, individual. Well, when an individual is making tax return, right? Of course, there's what we call basis of assessment. We'll have what we call PYB. That's actual year. That's we'll have actual year basis, and they'll have a preceding year basis. Sorry. So preceding year basis is the PYB, and actual year basis is the AYB, right? So for individuals, of course, it depends on the scheme. For individuals that is under employment, of course, this year from your January salary, the new tax law, of course, will kick in, right? So you're expected to see the changes immediately from that. But for somebody that is doing business, like a self-employed person operating under an enterprise or business name, it's also treated as individual ordinarily. But if you're making your assessment, you're declaring your income, of course, what you're supposed to declare will be at the end of the year. So at the end of this 2026, not what you made last year, because of course the law has taken effect from the January. That's how I believe that should be treated. Of course, there's also going to be further guidance around these issues. So then for the other one, which is, what if you make a loss on your overseas income? So when you say make a loss, I don't know who, I would have loved the person to be there. So if you say make a loss on your overseas income, will you claim a relief? So if you are doing business overseas, except you're in Nigeria doing business overseas, but I am going to presume that you live overseas and you're making, if you live overseas and they are doing business overseas, and you make a loss, of course, that has nothing to do basically with Nigeria. Of course, if you live there, you're not a resident of Nigeria. Remember, taxation is based on residency. So if you are living in Nigeria, perhaps you have business you are running abroad, and then you make losses on that, and you also have another business. I also presume you also have a business back home. But when you say back home, will it be relief on the tax you pay back home? So I wish the person is there to actually clarify. Sometimes it's easier to understand when we communicate directly. But the what I will say to that is, pending when if the person comes up to clarify the question, is to say that if you make losses, right, on your business generally, of course, they don't call loss relief. There's a provision for loss relief, right? Even as an individual preparing your income tax in your tax filing, there's a provision for loss relief. So loss relief is also expected to be deducted before arriving at your tax or your total or taxable profit. All right. So that is also there in the law. You must be able to recognize that. Let me give a practical example. If I'm a freelancer and I have various sources of income, let's say I have investments. I'm also getting, let's say I have properties and I'm getting rent from that property. That's one source of income, one stream of income. I'm also a brand ambassador. I'm also earning, I'm getting paid by the brand. That's also another source of income. Maybe also I have a business, maybe online business I'm running. That's also another source of income. So I'm going to bring all of this income together. Let's say on the online business, let's say I sustain a loss on the online business, which I can of course prove with documentary evidence. Then that loss you were allowed to relieve the loss when you consolidate the entire income or sales or whatever. You deduct as part of your allowable deductions in filing your personal income tax. If you look at the law, it's clear. You're also allowed to deduct those losses. Of course, and even if the losses are so many, you can even carry them forward. I think up to 4 years or so. So that is that's about that. Then for the other one that says, again, we need that person to clarify what it meant by worldwide income applied to holding company transferred to an operating company in Nigeria and all that. So I don't know what that means. I don't want to.
Okay. I think that if we were to rephrase that, so because we talked about the worldwide income, the global income, that is under for Nigerians, resident or non-resident, that comes under the tax purview right now. That if you were to have come back to Nigeria and have that operating, you had a holding company there, maybe offshore, overseas, transferred to an operating company in Nigeria. So would that income be taxable in Nigeria? So let's say that the holding company is overseas, but they transfer, but they also have operations in Nigeria, operating company or operating business in Nigeria. Would the terminology of the global income or worldwide income apply to such a structure or a scenario where you have an holding company offshore or overseas, but the operating entity is in Nigeria?
Okay, so maybe I will answer in this way. If you maybe this will address it. Before the reform, before this recent reform, a Nigerian company is actually defined as a company incorporated in Nigeria.
Okay.
But this reform has introduced a very interesting dimension that's brought up another kind of definition, which is if a company, regardless of where they are incorporated, is effectively managed in Nigeria, right, that company is also termed a Nigerian company. So this is an interesting twist, right? So, and in line with global best practice. So the definition of Nigerian company was for a long time limited to just incorporation. So if I go to CAC and I incorporate a company, that's a Nigerian company, or register a company as a Nigerian company. But in some other countries, they have other definitions, right? Or whatever the other criteria that determine a company that is resident for tax purposes in their country. So far on within the context of what we're discussing, now we have a new dimension to this. So if you have a company, holding company that is abroad, which is usually the part of the tax planning done by some persons, they will have a holding company abroad. Let's say, especially usually in tax havens, right? You have a holding company. You'll be surprised that most companies that you know in Nigeria that are popular brands, that they actually, the holding companies are actually in somewhere like Mauritius, in British Virgin Island, in Isles of Man, they are in Bermuda, they are in Seychelles. That's where they are. Those islands where there is either zero or no tax at all. I mean, either zero or low tax. So there. So what they do is that those holding companies are situated in those places. But again, nothing happens in that place. It's just what we call a PO box, just a post office address. There's no office. There's no economic activity. There's nothing going on, right? It's just to hold those investments. So, and again, the law is saying now that as long as the decision makers are in Nigeria, right, people operating the company, that is the operating arm, is not doing the business in Nigeria, and taking decision whatever happens within that group they are in Nigeria. Of course, that company is a Nigerian company and will be subjected to tax in Nigeria. So meaning that the worldwide, that's a holding company is no longer going to be. It's not going to no longer going to be business as usual for those using holding company structure.
Thank you so much. Yeah, thank you so much. So at this junction we are going to close the session now. So want to thank all our participants that have been with us. This is almost 2+ of conversations. We didn't want to break into it, and we wanted to make sure that as much as possible some of the issues that we wanted addressed and highlighted, that we are able to get around to it. But we want to thank our speakers. We want to thank Dr. Iyika. We also want to thank Mr. Tunji, Mr. Aino Tunji Bello. Thank you so much for your time. Thank you so much for being here. And thank you to everyone that has been with us from the start of the conversation up until now. The recordings will be made available and other snippets as well. And if you've been following us, if this is your first time joining any of our webinars, we have these webinars twice in a year. We have it at the start of the year, and we have it at the once we get to half year. It's actually targeted at discussing with the community, with our clients, with those that we work with in our fiduciary services, looking at the trends and dynamics that affect their lives, affect their families, affect their legacy. That's all we are all about. Making sure that the wealth that we produce as an individual, as a family, they are protected and the legacies are preserved. And as we've heard today, tax is a very important element. We cannot plan now outside not planning for tax. So if tax was not something that we used to consider in our estate planning, in our wealth preservation planning, and we didn't give it as much attention, now we have to take advantage where we can and also make sure that we comply going forward. We have made some newsletters available over the period of time, so please do check out our pages. We would also make sure that we share this with everyone as well as part of the post-webinar activities. So when it comes to personal housekeeping, what you should do as an individual, as a corporate entity, as a family, as a business, we've articulated it for you. So please look out for our newsletter on personal housekeeping, how you could best manage yourself and your your business and your family. We also looked at My Trust, My Tax is also part of the newsletter that we have. We also look at the digital economy and those that operate within that space, and what are the tax compliance that comes to fore. If you have a charitable initiative or you want to make donations, what is in it for you? How do you take benefits, especially as a corporate entity within the tax space? Then we are looking at Nigerians in diaspora as well. Why should you be concerned, if you should be concerned at all? And just encapsulating everything we've talked today is just the fact that this is an era of transparency, and we all have to make sure that we understand what the law says. And if we need redress and every other thing, there are opportunities for redress. The Act contains redresses, the ombudsman, and what can be done. So at the end of the day, tax is all about the revenues, the income. It's not about what you have to. So there's no one that is supposed to tax poverty. So it's just the revenues, the income. So proper documentation, proper understanding, speaking to your advisors, speaking to reading up as well on your own, and making sure that you have professionals that are coming to the fore to help you would make a whole lot of difference for you. Thank you so much once again to everyone, and we do hope that we'll see you at the next iteration of our webinar. Thank you so much. Yeah. At this junction, we would call it a day and say till next time. So please do join us again next time, and we look forward to a much more fruitful and impactful session going forward. Thank you so much. Yeah.
Right.
Bye for now.
Thank you
Yeah,
for the opportunity. Thank you, Dr.
Yeah.
Thank you, sir.
Thank you, Mercy.
Thank you, sir. Yes,
Doctor, I
thank you.
will reconnect with you through Mercy.
No problem, sir.
Thank you. Yeah.
Right.
All right.